This video is for educational and informational purpose only. Please consult your financial advisor before investing your money in stock market. Hello guys, today we are going to discuss about Indus Ind Bank, and in this video we will focus only on COVID-19 implication and recent earning call. Let's focus on COVID-19 implications by bifurcation of their complete portfolio. First, we will talk about the business loans. Business loans constitute 6% of their complete portfolio. And key points to note here is that negligible capital market exposure. Ticket size is around 2.5 crores. It's completely sole banking, cash flow based, and we can see that less than 8% of portfolio is impacted like retail, tour and travel, etc. The best part we can see here is that they have a very proven record in earlier shock of GST and demonetization. So they have survived them and has come out with very good recovery. Then we will talk about loan against property, which is 5% loan. And as we know, this is a secured loan, very well secured and distributed. These are generally a small business owners, smaller than even a business banking. The ticket size here is 60 to 70 lakh. Portfolio LTV is 50%, mostly self-acquired. Let's move further. Now we see the microfinance loan. This is a good chunk of 10% of their complete portfolio. It is a ruler focused and ticket size is approximate 25,000. It's majorly grocery, retail, weaving, tailoring, and account for 60% of the loans. And we know that currently the essential services are completely open. Hence, it will see less likely impact. And they have a proven record for Kerala floods. If you remember, 90% they have recovered, and for demonetization, 96% has they recovered. And we can consider Kerala floods is another disaster which happened even in those areas where the essential services was the key challenge. It's self-employed livelihood loans, and you can see that how they are taking an action in every department of their portfolio. They are working at ground level. For example, here virtual city center meeting, engage 8 lakh customers per a day. Contact center and helpline is fully operational, and the loan manager is basically are in touch by phone to give them a health and safety advices. Then we have another part which is 5% of loan, which constitute card and personal loan. It is very well diversified, and focus here is on higher end of income and social pyramid. These all are salaried individuals. The main point here we note is limit on analysis of disposable income. Contact center again is fully operational. They see some elevation in delinquency. However, in each of these portfolio, the 3 month moratorium applied by RBI would help them to overcome their NPA. And they assumes the normalcy very soon as the situation stabilizes. Further, we have a commercial vehicle loan, which is a very big chunk of their portfolio. The best part here is that the 70% are the repeat customers. Then the ticket size is 6 lakhs, 12 lakhs, and 30 lakhs. Greater than 90% are small road transporters with 3 to majorly 10 vehicles, not more than that. If you see the track record, that credit cycle management over 30 years by the same team. It has been managed by the same team. Again, 3 months moratorium will help bank and tend to bounce back rapidly once the disruption is over. They again are very closely contact with the customer for their health and safety, and contact center is fully operational. Then we move further is about the passenger vehicle and two-wheeler loan, which is 6% of their loan book. Majorly ticket size is 5 lakh and 0.5 lakhs for two-wheelers. Large percentage is self-employed. Again, 3-month moratorium will really help them. And overall, for any rural areas, they see very less impact there as of now because of earlier lockdown initiated by Indian government. They also catering day-to-day essential services, so it is helping them not to default. Next we have is gems and jewelry, which is very less of 3% of their complete loan book. They see a negligible impact as on date on a portfolio with no SMA. Again, RBI 3-month moratorium will help to adjust the supply lines. They all are reputed jewelry retail chain from B2C. Risk weightage is always 73% based on external ratings. Moving further, real estate is a 4% of the loans, and they see a delay in projects due to the lockdown and labor migration. We have seen a lot of migration happening from metropolitan cities. So as the situation will recover, these migrants will come back again as expected and the projects will start. However, there will be some delay even after the lockdown. In many areas of real estate, the team is working from home without any business impact. Similarly, for NBFC, which is a 3% of their complete portfolio, team is working from home without any business impact. And in fact, the loan book has been there and there are sales happening. Several niche retail financial example gold vehicle. They see some elevation in delinquency if the disruption extends beyond 3 months. Again, 3-month moratorium will help them. This is a very good step which has been taken by RBI to help all the banks so they can recover very rapidly once COVID-19 situation is over and controlled. Now let's see what are the key takeaways from the earning call. So due to lockdown services, they are expecting normalization in 3 to 4 months and major demand will recover in first quarter FY21. In CVs, as we understand in earlier slides that 70% of their business is from repeat customer and which has been the business from last 2 decades. And the best part is that the complete Indus Bank team is closely working with all these customers and helping them to overcome any COVID-19 implications. Their retail deposits have been grown 18 to 20% year on year, which we have seen. So likely we assume and we expect whatever the earning cuts would be there, it would range around between 12 to 15% for this year and next year. then the bank will maintain their 15% as threshold for CRAR. Promoters have applied to the RBI for raising their stake to 26%. And if we see overall, we are expecting earnings to be cut by 6.5% for FY20, 26% for FY21, and 14% for FY22. Now let's come to the conclusion about the fair price. Currently it is trading at rupees 342. Price to book is 0.89, which is very cheap. PG ratio is 0.31, and currently industry price per earning is 12.62. If we take from very conservative price per earning 12, the, the fair value comes around rupees 780. And even if we see that if we if we make it value twice the book value, it will be coming around same price. Then according to Benjamin Graham strategy, with the 10% growth rate, the fair value comes around 814. However, we are expecting the growth rate to be 12 to 15%. Then from a Warren Buffett strategy of a book value expecting a growth of 12%, the fair price comes around 733 rupees. That's it guys. If you find this video useful, please like it and subscribe to channel. Thank you.